Okay. I know everyone's tired. It's not ideal to now have to sit through another couple of hours of lectures. I'll try to make it as painless as possible. But having said that, today's session is quite important because as I mentioned last week, we've now moved away from Black-Scholes, and today's session is all about foreign exchange. Okay, so what we're going to really drill into today is foreign exchange modeling, foreign exchange derivatives, and maybe you can think of this in 4 parts. Okay, so we'll start off by just introducing the idea of FX options, how to price an option on an FX. Okay, so now our underlying asset is a foreign exchange rate. Okay, it's some foreign currency which has some dollar value. All right, and we'll look at pricing options on FX. And one thing we're going to go over again is this idea of a continuous dividend yield model, which I think you were introduced to in week 2, maybe? Week 2 or week 3. If you understand the model, the pricing of an option on a dividend-paying stock, continuously yielding dividend. If you understand that, then you'll understand part 1. Okay? It's actually exactly the same. The symbols are different, but the economics and the maths are all exactly the same. So maybe it's a good time to go back to lecture 2, recap on continuous dividend models. I'll give you a short recap here today. But we'll basically rederive the PDE, the risk-neutral pricer. It's really stuff we've done already, so nothing complicated there. And then the twist. Because this is the first time in the course where we're dealing with 2 different currencies. Okay, so far, we've always dealt with one currency. Whether you thought about it or not, when we were writing an option on an equity, that option always had a price in dollars because the underlying equity was priced in dollars. It didn't have to be dollars. It could have been an equity priced in yen with an option priced in yen. We didn't think about it. Okay, we didn't really give too much attention. It was whatever currency. But for the first time, we're now going to introduce 2 currencies because foreign exchange is the relationship between 2 currencies. Okay? And that means you can think of it from either currency A or currency B. Okay, that's what I mean here when I say domestic versus foreign. Okay, you can price the same option either from the perspective of currency 1 or the perspective of currency 2. And I'm just going to show you that relationship. It's a triangle relationship. All right? And then part 3 is we're going to go back to forwards, forward contracts, more specifically forward prices. Again, this is something that was introduced week 1. And it comes up here because now we're starting to prepare for next week where we introduce interest rate modeling. Okay, so everything we've done so far, we've ignored interest rates being stochastic. We've assumed interest rates are deterministic or constant, and we've kind of just put it away. Next week, we're going to relax that. We're going to think about stochastic interest rates. And because today we've got 2 currencies in the picture, we've got 2 interest rates. Okay? So if you're worried about stochastic interest rates, you're doubly worried in the case of FX options because you've got 2 of them. Okay? Fortunately, this approach here, when you think of things in forward space, helps you to deal with the problem of stochastic interest rates without really dealing with it. Okay? You kind of brush it under the carpet. It's a way of circumventing the problem. Okay? So that's why I bring it in. You price using forwards as opposed to pricing using spot. And finally, quanto derivatives, which are a big topic. If you want to think of it as part A and part B, everything up above this is part A and quanto derivatives are part B. And quanto derivatives are really derivatives which, I'll give you a concrete example later, but they're derivatives where you try to remove the FX risk. Okay, now you might think to yourself, well, if you're removing the FX risk, why is it coming in when we talk about FX? Well, that's because from the perspective of a client, the FX risk is removed. But from the perspective of a trader, a market maker, a bank who is selling this quanto derivative, actually it matters a lot. Okay, so quanto derivatives are really part of FX because You have to get involved in both currencies. Okay, so the FX market is huge. Okay, I don't know if you can see this, but the first line says that as of April 2022, the global turnover in the global FX markets reached $7.5 trillion per day. Okay, $7.5 trillion per day. That means, investors or banks, market players are exchanging one currency for another, and the total amount that's going through this market each day is $7.5 trillion equivalent. Now I want you to stop and think about that for a moment because it's a huge number. Okay? The GDP of the United States, does anybody know what that is as a number per year? It's about 20 trillion. 30 trillion. China is about 20 trillion, a little over 20. Okay, so what's the GDP? It's the value of all goods and services that are bought and sold over the course of a year. So if you go out, you buy an iPhone, that transaction gets recorded somewhere, that contributes to GDP. You go out, book a holiday, get your car serviced, any other service, if you pay for it, it gets recorded, and that contributes to the GDP of the country. And a country like the United States, which has the biggest GDP in the world, that's 30 trillion per annum, per year. This market is 7.5 trillion per day. Okay, so it's a huge market, which means that the market in FX options and the market in FX derivatives is going to be pretty big. Okay, because if the underlying market is this size, it gives you an idea of how much money is going through the system, and you can bet that a lot of market players are hedging their risk through derivatives, through options. Okay? So derivatives can certainly hedge some of that risk. So it's a huge, huge market. Now for the first part of today's session, I'm going to focus on FX options pricing. Okay, everything we're going to talk about is applicable to derivatives, FX derivatives in general. But I'm going to focus on FX options just to give it a bit more realism so that you can relate to it. But as I mentioned, we have all the pieces already. The biggest one is the continuous dividend yield model. Okay? So back in week 2, you were introduced to the log normal model for stocks. I think it was week 3 actually, probably. You were introduced to the log normal model for stocks. Okay, and then we said, well, stocks, equities pay dividends. And usually they pay dividends every quarter, every year, every 6 months, whatever. It's fixed points in time. But that's quite a difficult thing to model. So we introduced something called the continuous dividend yield, which is another way of saying that every day you hold the stock, you get a little bit of income. Okay? Every day. That's what a continuous dividend paying stock does. Okay, so if you go into the lecture notes, it's in section 3.53, continuous dividend model. So the dividend yield is a quantity Q. Okay? Another thing I should have mentioned, it's a proportion of the stock price. So whatever the price of the stock is, over a little time delta t, you get Q times S times delta t. That's the continuous dividend yield model. Now we said that there are two important properties that this model encapsulates. One, which I've just mentioned, the dividend is paid continuously. The second one is that the dividend is reinvested in the stock. Okay, that's the assumption we're making. Any dividend that you're paid in cash, but you don't keep the cash. You reinvest it and buy more stock. Okay, so no money goes in or out. It all stays in stock. And we introduced this concept D, which is the dividend process. Okay, it's the uninvested dividend. So you have this dividend process, you have the price of the stock, but we also introduced the idea of a wealth process. Okay, so now if you think of yourself as an investor, you go out, you buy a stock which pays dividends. What you really care about is, you care about whether the stock price goes up or down, of course, but you care about your wealth as an investor in the stock. Okay, and your wealth comes from two places. One, stock price goes up, your wealth increases. Stock price goes down, your wealth decreases. But you also have wealth accumulating from the dividends. Okay? So your wealth process is the cumulative effect of the stock price movement plus the dividends. Right? And that's why we introduced this thing called S tilde. Okay? S tilde now measures the growth in the value of the stock. That's this first term here. That's the Brownian motion. This is the additional dividend yield. Okay? But it's reinvested in the stock. That's why S tilde is your wealth process. Okay? Wealth coming from the growth in the stock, wealth coming from reinvesting of dividends. And if you solve this, your final wealth at time big T is essentially the price of the stock times this adjustment factor. Okay, so you go out, you buy 1 unit of stock today. It costs $100. Let's say the stock price goes up to 110. Your wealth is not just 110. That's what it was in the absence of dividends. It's an enhanced value in the stock. So you end up with more than one stock, right? Because all the dividends you picked up, you reinvested back in the stock. Okay, so e to the qt is more than 1, right? Because q is bigger than 1. St is just the value of the stock. That's not to say that this wealth is more than S0, right? It could be more, it could be less. It really depends on St. But the point is that you get an enhanced holding in stock because you've reinvested your dividends. Okay, so why am I going through all this? The reason is because the dynamics that we will introduce for fx will be exactly what I've just described. Okay, so the picture, the image I want you to have in mind is this. Everything we've done up until now, we've thought of S. Think of S as an asset, right? A share in a company, Amazon. If you invest in a share, it's like you have a piece of paper that entitles you to ownership of Amazon. Part ownership, right? That's what a share is. And this has a value, $100. I don't want to call it Amazon because it's more like $230 probably today, but whatever it is, right? This piece of paper, which is like a share, you know, in the past, a physical piece of paper used to prove your ownership of the stock, but it's worth something. $230 today, tomorrow it moves up and down, etc. What we're doing with FX is not all that different. Okay, so let's say we're talking about the GBP USD, a foreign exchange rate. Okay, this is an asset. What you need to be thinking of is that there is a piece of paper, I don't know, with a king's face on it, £1. This is a piece of paper, but it has a dollar value. Okay, and today it's about 1.3. And the point is that that value can move. £1 stays £1. You go to the UK, you can spend that £1. But in dollar terms, it has a value that fluctuates every day. So you can think of this as being an asset which has some dollar value. Same as 1 unit of stock has a dollar value. Okay, that's all that's going on. We'll worry about the two currencies later. For now, think of everything in terms of dollars. Everything has a dollar value. Right? So now when you see that these two are the same, essentially, conceptually, right? You have an asset S, which has a dollar value. You have this asset, FX, happens to be a foreign currency, which has a dollar value. We're now pricing an option on this asset. Okay? Now here's the thing. Here's where dividends come in. If you went out and bought this piece of paper, this £1, where does the dividend come in? Anybody has any ideas? If you went out and bought a foreign currency, what are you going to do with it? Say again? Yeah, right. You put it in a bank, it earns interest rate. It earns interest rates in what currency? In pounds, right? So the dividend, and the dividend is basically that interest rate. Okay? And we've already established that we've got this continuous money market account. So if we have a foreign money market account into which this foreign asset goes into, it's generating income. Okay? And it's automatically being reinvested, right? That's what an interest rate account is. It gives you an interest payment in the same currency. So you're getting interest in pounds. So that's why it's exactly the same problem. It's an asset that pays a continuous dividend yield, where the continuous dividend yield is the foreign interest rate. Okay, so that's the important part. This thing is just the foreign interest rate. We still have a domestic interest rate. We still have a dollar money market account, right? Same as we did with S. So this is a good time, really, to go back. I think at some point, in the notes, yeah, there's a case study. Options on dividend-paying stocks. And I think one of the exercises was to derive the PD. Okay? That was the PD for an option on a dividend-paying stock. When S is an FX rate and Q is the foreign interest rate, that's exactly what we're going to end up with. Okay? So you've already seen everything I'm about to show you. You've just seen it in the context of a dividend-paying stock. Okay? But I hope you're convinced now that foreign exchange is nothing more than an asset that pays a continuous dividend yield. So the Black-Scholes model comes in. That's easy. You've seen that before. I'll talk about forward dynamics as a way of alleviating the problem with possible stochastic interest rates. And by the way, in all of this, volatility skew hasn't gone away. Okay, so last week we talked a lot about volatility. We spent the whole session talking about volatility, stochastic volatility, volatility skew, smiles. That's all still in the picture. Hasn't gone anywhere. Okay, so we need to differentiate and distinguish between the spot FX process, which I'm going to call X, and I've already used the pound-dollar exchange rate. Sterling dollar is often called the cable asset. It's called cable in the markets. It's how much £1 is worth to a dollar investor. Okay, so we have a spot FX process. That's just X. That's the number you see if you go into the market and you want to exchange pounds for dollars. If you're going on holiday and you want to exchange some money. Okay, that's the rate you can exchange it at. But if you're an investor in pounds, then you care about what I call the wealth process, which is X hat. Okay? And that's basically the component to wealth, which comes from the fact that the FX can just move in your favor or against you, but you're going to get some dividend, okay, which is always in your favor, assuming interest rates are positive. Okay, so Q in this case is just the foreign interest rate. Okay, so Q is the foreign interest rate, which I'm going to call R foreign. And again, we'll assume it's constant. Okay, we'll assume it's constant like we assume the domestic interest rate is constant. Okay, so we have all the pieces we need to derive that PDE. Okay, that's the PDE for an option. Sorry, not an option, for an FX derivative. It's valid for any derivative V. I will use it to demonstrate the pricing of a call option. Okay, that's why I have here. VT. This is the risk-neutral framework at play. Okay, it's still valid. Shouldn't surprise you because it was valid for a dividend-paying stock, so it's valid here. And these are the risk-neutral dynamics. And this is the bit that maybe looks a little bit off-putting, but it's really, that's always been there. Okay, I've never put the dollar previously because we only had one interest rate. Okay, previously I just had R, but now we're talking about R dollar because we're assuming we're dollar investors. I never had R pounds before, I had Q. Okay, but they're analogous. It's exactly the same thing. So let's do the derivation exercise. And certainly, something like this, proving this could come up on an exam. Right? Writing down the steps to go from some basic dynamics to that PD could come up in an exam. Solving this, if I say, or if the question says, use risk-neutral valuation, you should all be able to solve this now. Okay? Even if you understand none of the economics of what's going on, you should be able to solve this because xt is just a log normal variable, two constants. Okay, so what? That's just a constant drift. That's a constant volatility. You've seen this before. We went through it in class. You should be able to solve this, okay, yourselves. But now I'm going to concentrate a little bit more on the economics, okay? Because we have two things in the picture. Everything on this slide is X. Okay? The question you might be asking yourself, well, why did we introduce X hat? Why did we introduce the wealth process? And I'll give you some starters, but this is something that you might want to do yourself by just writing down the mathematics, going through the derivation. I'll start you out because it's not complicated. It's too messy to do it all on a board, so I don't want to do that, but I'll give you the pieces you need. And I think the notes have some more details. Okay, so where are we? Let me see if I can. All right, so we have X as the X is your foreign exchange rate. You have the wealth process. Okay, the only difference is that part there. Our derivative is a function of time, always, and it's a function of X. That's what it means to write a derivative on the foreign exchange rate. Okay, it's what we did before. Our hedge portfolio, which I've always called pi, and I'll stick to it now, is VT plus some units of XT plus some units in the money market account. Okay? And this is where things change. You would be tempted to write this. And this is what we did when we had S, right? When we did Black-Scholes day one. The problem is if you're an investor in X, okay, here you're an investor in X. Here, the derivative just observes the value of X. So they're two different things. What you need to do, what you really care about, is the wealth process associated with X. Okay, so you're going to hold some units of X. But if you hold X, what you really care about is X hat. Okay? Now what do we do? This should all be very natural to you now. The whole point is replication, self-financing strategies. Replication means we need to have a portfolio which starts off with 0. and the portfolio value stays at 0 for all t. If you've done that, then pi is basically a closed system, no money goes in and out. That means Vt is offset by this, which I call the replicating portfolio. Okay? So this is the replication principle. So, if this was an exam and we were doing the derivation, this would be enough. This is what you would need to write down. Okay? You would also then need to write down the self-financing strategy. Okay, and the self-financing strategy is basically x hat d delta plus b d psi equals 0. Okay, that's saying nothing more than if you need to adjust the holding delta of this foreign asset, you finance it from the money market account. Okay, so these two sum up to 0. That's what the self-financing strategy is. Okay, so now you need to compute d pi. And not only that, the only hope you have of ensuring that d pi is equal to 0 is to remove any randomness. Okay? If pi, as a portfolio, has randomness, you have no hope of ensuring it stays well behaved and stays at 0. You can't control it, right? That's the point of randomness. But if you eliminate the randomness, you have a chance of ensuring d pi equals 0. Okay, so how do you eliminate the randomness? That's delta hedging. Right, so you call this dv plus delta dx hat. Okay. What's dv? Well, that's just Taylor. Note it's dx. Okay, v is a function of x, not x hat. And this, of course, is the Ito term. So the way you make this risk-free, now you can expand this. You know from up here put that in there. Okay, and from up here this goes in there. The point is you need to knock out all the randomness. Okay, so just write down the maths. There's no easy way to do it. You just write down the maths. Okay, I don't know if I have it, but what you'll find is that delta t has to equal minus e to the minus q t dv by ds. Okay? You see, if q was 0, you just have exactly what we did before. Okay? But this choice in delta eliminates all the randomness. Okay? And the rest of it is just maths. You just write down the algebra. Okay? You write down d pi equals 0, and that will lead you to the PD. Okay? As I say, I don't think it's worth going through each step. It's really just simple algebra. You can write it yourself. I've written down the main components, the new components, right? The x hat, this slightly different form of delta. If you're struggling to get this form of delta, you're missing something. But if you get it, you've understood what's going on. Okay? Here you need to remember maybe something else I need to write. You need to remember that what did we have? We had x hat to the e to the qt times. Okay, this is an important relationship, right? Because you've got x hat and x in the same place, so you can always go from one to the other. This is the relationship that links them. Using that relationship, you should be able to get to this PD. Okay? You've knocked out the randomness. You've made d pi equals 0. What you're left with are just these terms. Okay? And actually, once you've got this term, going from here to here is nothing new. Going from there to there is just the application of Feynman catch. Right? You've seen it a number of times now. I don't think we need to go over it again. But going from there to there is nothing new. You've seen it already. These are the dynamics that are introduced. These are the dynamics you need to follow to be able to go from there to there. Okay? You take this expectation under the dynamics where the foreign exchange rate follows this drift. Right? So mu has disappeared. Okay? Mu up here disappears. Okay, you'll see that as part of the derivation. An important point to note is that even though we've got two currencies, dollars, pounds, really everything here is dollar denominated. Okay? If you ever get stuck, you're confused, you get lost in the two currencies, and I promise you, you will, just go back to the simple example. Stop thinking about it as a foreign exchange. Think about it as some foreign currency, which is a nice, colorful piece of paper, which has some dollar value. Okay? Microsoft could be another colorful piece of paper, which has some dollar value. You've priced an option on that Microsoft stock, so you can price an option on £1. Okay? Are there any questions on that? You do the derivation. As I mentioned, you can even solve it, right? All of you can and have written expressions like this. We did it in one of the lectures. Okay, so you should be able to derive this yourself. You don't need to learn this. Please don't go ahead and memorize this. Okay, it will not add any value. You will never get any points for memorizing it. Any question on an exam will ask you to derive it. Okay, which means going in and solving the expectation. Thinking about whether you want to work in units of z or units of s. Okay, writing down the Gaussian distribution functions, using Kirsanov's theorem, all that stuff. But you should be able to come up with this. If you compare it to the Black-Scholes call option, it's very, very similar, right? Very similar. You've got D1, D2, which are related by this sigma root t term. You've got the cumulative distribution function of the Gaussian, psi. You've got this term here, which looks very familiar to what you've seen before. So this is a very famous formula in FX options. It's called the Garman-Kolhagen formula. I don't know why it's got a special name, because we knew all of this when we priced options on continuous dividend stocks. So for some reason, these guys got their name attached to it when they applied it to FX, even though it's exactly the same problem. Okay, but that's the formula. I would say it is worth your time to try to derive it. Definitely. Two interest rates at play. For now, we've assumed they're both constant, right? One interest rate was always there. The other one is what we previously called Q. Okay, so it's identical in spirit to a dividend-paying stock. It's more realistic, right? Stocks, as we said, don't really pay dividends continuously. They pay dividends discretely. But cash held in a bank, yeah, it's more believable. It pays interest on a daily basis. You can imagine that. In fact, we assumed it. Our money market account is exactly that. It pays interest on a daily basis, e to the RT, on a continuous basis, not even daily, continuous. Okay. Now here's a question, and this is kind of setting up for next week. So next week's the big session because we're going to start talking about stochastic interest rates. What if we can't, for whatever reason, don't want to assume constant interest rates? If we're worried about stochastic interest rates in a equity model, okay, if we're worried about interest rates being random when we're pricing stocks, we're double worried about it now because we've got two of them. And they're two different interest rates. So you've kind of got two additional stochastic variables into the problem. So this is kind of setting us up for next week. Next week we'll do it properly. We'll introduce a real model for interest rates. Today, I'm just going to kind of avoid the problem. Okay? I don't want to call it cheating. It's not cheating, but here's the thing. If you had ds is equal to rs dt, we know that on average it did that. Okay, that's e to the, right, you've seen that. We know it's random because of this. But the point is that if I set that to be 0, okay, if I set it to be 0, and r is deterministic, that you're still nice smooth, right? It's still an exponential growth function. If r is stochastic, you've got randomness even though sigma is 0. You see that? Okay, if I'm choosing to make r stochastic, I've got a problem. I've got two sources of randomness. And it's coming from that drift. So I really don't like that drift. When in a world where interest rates are stochastic, I really don't like that drift. It makes my problem double stochastic. So the dynamics I'm about to introduce is a way of alleviating that. Okay? It's kind of like brushing it under the carpet. It's avoiding the problem. It's not addressing it. Addressing it would be to introduce a model for stochastic interest rates and do things properly. That's what we'll do next week. For now, I'm going to remind you what the definition of the forward price is. Okay? Now we're going back to week 1. Hope you all remember this formula. Sorry, you shouldn't memorize formulas. Okay? You should be able to derive this formula. That's the forward price. How do we derive it? Simple arbitrage-free replication arguments. Okay, the forward price is the price that you're prepared to pay for an asset in a year. Okay? So capital T minus is in the future, in a year. T is maybe some point today. That's a formula we derived. That's the forward price. Okay, now there's something nice about this forward price. What happens as little t goes to big T? Forward price goes to ST. Okay? The forward price converges to the spot price as time goes to the maturity date of the forward contract. Okay? So what do we do if we wanted to price an option on, this is as t goes to t. So now if we want to price an option on the forward price, now I'm not pricing an option on the underlying stock. I'm pricing an option on a forward, kind of like an option on a forward contract. And we have 3 dates. We have T0 today, we've got T star, option expiry, and we've got T, forward maturity. Okay, we've got 3 dates. And I'm saying let's take this option expiry and push it to T. It can never go beyond T. It can never go beyond capital T because the forward contract terminates at T. So it doesn't exist beyond capital T. So the option can only exist up until time capital T. Okay, so let's take a look at that special case where T star is T, an option on a forward. And because of this relationship, an option on a forward is equivalent to an option on a stock. Okay, so I've now got 2 ways to work out or to think about an option on S. I can either think of it as an option on S, as I've always done, or an option on F. Okay? Option on F. Okay. What are the dynamics of F? And it turns out this is the neat part. The dynamics are just that. Okay, no drift. That R that I had disappears. Okay, now how do we get this? How did I get it? Well, it's just simple. Simple application of calculus, right? We're saying that Ft, okay? The question is, what is dF? And as always, we apply Taylor. It's dF by ds plus a half d squared f by ds squared. Plus df by dt. Okay. If you expand it, okay, it's not worth. Let's do it. df by ds is just e to the r t minus t. ds we've already seen is rs dt plus sigma s dwt. What's this term? 0 in this case, right? Because it's linear first order in S. So this term's 0. What's this term? df by dt, simple. Time is in the exponential. You all know how to derive. Take the derivative of an exponential. This is just st minus r d by dt. Okay, and what you know, this and this disappear. Okay, so you're left with just this term. And S and e to the RT is obviously F. Okay, so it's a trick. It's a way of just suppressing the term with R, right? We just got rid of it. It's not gone, it's there because we've written our dynamics now in terms of F, but we don't have a drift. That's the important point. What you will also notice is I've written it sigma S, sigma F. And the question is, when is sigma S equal to sigma F? And they're equal when interest rates are deterministic. Actually, as I've just shown, right, here, we've seen it. Sigma for df is the same as sigma for the stock price process. Now, when R is stochastic, that is when sigma S is not equal to sigma F. Okay? And that's not surprising, because sigma S is the volatility in the stock price. Sigma F is the volatility of the forward. The forward depends on the stock price and the interest rate. So sigma F is it's a composite volatility. That's how it's referred to in the market. A composite volatility. It encapsulates the volatility of both interest rates and the volatility of S. Okay? So that's why we've introduced stochastic interest rates, but we don't see it directly. The volatility associated with it is all in here. And it works because we're in this unique situation where the forward converges to the spot. Okay? Any questions on this? One question you might have in mind is, okay, well, we had sigma S, fine. Now we have sigma F. Where do we get it from? What's sigma F? Well, we never had sigma S either. Where do we get sigma S from? Where do we get sigma S from? That's what we talked about last week. Sigma S comes from the market. We can imply a volatility from the market. Now, we imply a volatility from the market as well. But unknown to us, that volatility has baked into it a volatility for S and a volatility for R. Okay? It's both. Because in this world, we've chosen to we've acknowledged interest rates can be stochastic, but we've not tackled it head on. We've just brushed it all under sigma F. Okay, so FX options, same thing happens. That was for S, but for FX options, it's exactly the same thing. Okay, what's wrong with the first equation? That could have been a multiple choice on today's midterm. There's a typo in there, and you should all recognize it straight away. It's not intentional, but this should be minus. Okay? I hope you all recognize that. That should be minus. But anyway, that's beside the point. Under these dynamics, where I've now introduced sigma F, I can make that statement about the solution of the stochastic differential equation for the forward price. I can price an option on S like this. Okay? So if I can price an option, I can introduce the concept of implied volatility. Right? It's just the volatility. If I can go out in the market, extract the price of an option at strike K, a dollar value, I invert it, and I extract out the implied volatility, and I get sigma F. Okay, so next, if you're wondering about what these Z factors are, we'll talk about it more next week. This is not entirely what you've seen before. What's also missing is previously you had an e to the minus RT up here, right? I don't have it because now we're saying R is stochastic. Okay, so we don't want to keep it. We can't keep it. Doesn't make sense to have it. So this is the forward price. And this term is going to be something that behaves like e to the minus RT. Okay, but we'll see it in more detail next week. For now, the important point is what we've done is we've introduced this forward price process, and we've used it to price an option that we've already priced before, but we're doing it kind of from a different angle. Okay? We're doing it from an angle where we've ignored the interest rate. Not ignored, the interest rate is still there, but we've avoided it. And that's a nice setup for a world where interest rates are stochastic, because you don't want to have to deal with interest rates if they're stochastic. Okay, so introducing the forward price process allows you to avoid it. Any questions on that? Okay, and really this point here, we can bootstrap sigma F from the market prices of options. Okay, so bootstrapping, extracting implied volatility from the market, extracting forward volatility from the market, they're important topics. Okay, you should be familiar with that. Be familiar with the bootstrapping algorithm. Okay, so it was on the midterm today. But basically you encapsulate all the randomness of X, R, and, there's two R's. In the world of fx, remember we have mu, which is equal to R, the difference between two interest rates. So if both of them are stochastic and they're both kind of moving in different directions, and W is also stochastic, you say, no, don't want to deal with that. I'm going to work under the forward price, where I only care about sigma fx, and I'm going to extract sigma f, or I should say sigma fx. I'm going to extract that from market options. And I know that that volatility that I extract actually is a combination of the volatility that comes from FX, comes from interest rates in the domestic, Currency, dollars, interest rates in the foreign currency, pounds, all into one volatility. So it's very convenient. Okay, we've really brushed the problem of stochastic interest rates under the carpet. All right, any questions with that? No, so sigma s, this one here, is valid when interest rates are deterministic, which is what I did here. Okay, here I took the very simple case where f is equal to se to the rt. Okay, I can only make that statement if r is deterministic. Right? If r was stochastic, I can't make that statement. But this is what we've seen so far. R is deterministic. That's the definition of the forward price. And I've just worked out the dynamics of df here. And you see that sigma, which is the sigma of f here, is the same sigma that was introduced by s. Okay, so that's why I'm saying the volatility is the same. But it's only true in this case because we have deterministic interest rates. If we didn't have deterministic interest rates, and you'll see that next week, that first, the starting point, that fails. I can't make that statement already. Does that help? It depends what world you want to live in. Okay? If you compute an implied volatility on the spot, that means you would have supplied interest rates somewhere, right? Right? You would have, because that's part of the Black-Scholes pricer. So you'll get some number. If you work in forward space, you may or may not, right? If you believe interest rates are deterministic. In a world where interest rates are deterministic, yes, you will get the same. Okay? You will get the same. So maybe for now, yes, you're probably right, you will get the same number, because we haven't really introduced stochastic interest rates properly. Okay, so these are, maybe this is the question. This is another way of solving the same problem. Okay, but you're doing it in terms of f. And in that case, yes, you will get the same implied volatility. Right, so just accept that for another week. All right, it's a good question though. Okay, okay, so I'm not going to talk about this, but volatility skew is still in the picture here. Okay, remember we said last week that Black-Scholes, what does the Black-Scholes implied volatility look like? Flat, right? That's the whole point. Black-Scholes assumes constant implied volatility by strike. And we said equity does something like that, and FX does something like that. Okay? And the reasons behind it is because there's a symmetry where if you go down this way in FX world, one of the currencies is getting distressed. That makes one group of investors panic. Volatility goes up. But if you go this way, it's the other group of investors who are on the other side who panic, and they make the volatility go up. So it's a bit symmetric. It's a mirror. They're mirror images of each other. More importantly than this, though, so far I've told you to imagine that we are dollar investors. We have this foreign currency, which is a piece of paper that has some dollar value. It's a £1 note. And we price an option on that derivative. The point is, we could turn the whole problem the other way around. What if we are pound investors? Right? What if we are pound investors? And we're talking about an option, but from the perspective of the pound investor. Everything should still be valid. Right? Everything should still work. Whether you're a pound investor or a dollar investor, the ideas of replication, the ideas of Black-Scholes, the ideas of risk neutral valuation should hold equally well, right? The currency doesn't matter. Currency should not matter. So here's the problem. Now let's think that we are pound investors, okay? And we want to value a derivative which pays out in pounds. We have a pound money market account. We can do everything we've done already, okay? But let's look at the same derivative. And I just need a few more minutes before we take a break. But remember, this quantity up here, what is that? That's a dollar amount, right? That's a dollar amount. But if we divide it by X, and that's the foreign exchange, it converts this dollar amount into a pound amount. So I can write V capital T as being some derivative which pays out this thing on the right, which is a pound amount. Okay? From the perspective of a pound investor, I've just written a derivative that pays out in pounds, whatever it is. V is always generic. I'm giving it this special formulation now, right? And I'm giving it this special formulation because I want to tie it back to what we've just derived. This is the risk-neutral valuation. This is the risk-neutral framework for a pound investor. Nothing different. This is V. This is the discount factor. But the discount rate here, the R, is the pound interest rate. Okay? And we take an expectation. Same as what we've done from the dollar investor's perspective. So let me rewrite it. Okay, you can rewrite this. I don't know if it's obvious to you guys, but xt minus k over xt is equal to 1 minus k over xt. I'm going to take the k out. And I'm going to call this yt. Okay? I'm going to call it yt because from the perspective of a pound investor, the foreign exchange rate switches, right? You don't think of the dollar value of this pound note. You think of the pound value of this green bill with Benjamin Franklin or whoever's face is on it. Okay? That's why we switch from x to 1 over x. And look at this. This looks very neat because this is just a put option on yt. Okay, so the important symmetry is that for a dollar investor, a call option to buy pounds is exactly the same as a put option from the perspective of a pound investor. The same trade. Okay, the same option. It's a call for one person, a put for the other person, depending on how you do your accounting, depending on whether you're a dollar investor who measures things in dollars, or if you're a pound investor who measures things in pounds. And again, you can solve this. Okay? You guys can solve. If you can write down the pricing formula for a call, you can write down the pricing formula for a put. Okay, the maths is identical. Okay, maybe we want to call this k hat. There's a k multiplier here. Fine. But if you do it, what you've now introduced is the foreign risk-neutral framework. You can write down the price of the derivative. Same derivative, right? It's the same derivative. But it's now written from the pound perspective as that thing up there. It's no longer a call, it's a put. Okay, so I take the k to the other side. That's just a standard formula for a put. K tilde is whatever, it's a constant. You solve it again, y is log normal. Okay, it's still log normal Because from the perspective of a pound investor, the exchange rates, the interest rates just switch order. And you come up with this. And now here's the question you should be asking yourselves. It's like we've priced the same derivative from two different frameworks, and we've got two numbers. What must be true about these two numbers? Or will they be the same? No, because one is dollars, one is pound. So they're not even in the same units. But what links them? The FX rate, right? They are the same when measured in some common currency. Okay, so this is the no arbitrage triangle. The V dollar that we solved and we wrote down a few slides ago should equal to V pound, which comes from here, multiplied by FX. And you can write it, right? You can write down all the terms, put it together, you'll see it actually matches. There is this triangle relationship, and it has to, right? Otherwise the framework's no good. You can't have a pound investor saying, you know what, my option costs this much. Dollar investor says, no, actually it costs this much. Even if you convert them to by FX, they're different. If they're both trading those products at different prices, what does it mean? It's an arbitrage, right? Figure out which one's cheap, buy that one, which one's expensive, sell that one. At the end, they will offset each other because they're the same derivative. Okay, so this is why we have two frameworks, foreign and domestic. Two different ways of solving the same option pricing problem, depending on whether you choose to do your accounting in pounds, if you're a pound investor, or if you choose to do your accounting in dollars, if you're a dollar investor. Any questions on that? Okay, let's take a short break. When we come back, I'll finish up on this section, and then we'll move on to Quantos. Any questions? Okay, let's take a 10-minute break. We'll be back at 9:20. Okay. Right, so one final topic before we close out and move on to quantos, another triangle. Okay, so fx is full of triangles. This is the correlation triangle. So first, let's just do some maths. Okay, say you have two log normal variables, x1 and x2. And they're both driven by different Brownian motions, w and z. But the Brownian motions are correlated. Okay, so there's some correlation. Now here's a question. What is the distribution of some variable y, which is just the ratio of x1 and x2? And I can tell you it's not normal. Okay? x1 and x2 are both log normal. What is the ratio? What is the distribution of a ratio of two log normal random numbers? Have you thought about it before? Still log normal. That's what I hear. Anybody else support? Still log normal, right? You can write down y as x1 or x2. x1 is x1 0 times exponential. There's some constant term plus sigma 1 wt. x2 0 exponential of some terms sigma 2 zt. Right? And you can combine the exponentials, so you get something like x2 0 times exponential of blah 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 sigma 1 w1 minus sigma 2 zt. Okay? So you get another exponential. This is a sum of Gaussians, so it's also Gaussian. So this whole thing is still log normal. Okay? And the key part is really, what is the variance of this? And we saw this way back when we did the basics of statistics. The variance of a sum is the variance of 1 plus the variance of 2 plus this correlation term. Okay? Now, why is this important? Because in the world of fx, we could have this situation. x1 is the number of dollars per pound. Okay? And we modeled that using a log normal distribution. By the way, do you think log normal distribution is a sensible distribution for fx? Do you think it's more or less sensible than a normal distribution? Interest rates can be Gaussian. Why are interest rates Gaussian? Why is that a good model for interest rates? Perfect. fx can't be negative, right? And Gaussian always admits some probability of a negative rate. Okay, so log normal is probably a better choice over Gaussian. So if x1 is some log normal distribution for the number of dollars per pound, that's one fx rate. x2 is the number of dollars per euro, it's a different fx rate. The ratio is this cross fx, the number of euros per pound, which is also an fx rate. Okay, and these three currencies are three of the most liquid currencies in the world. The market is very rich. By rich, I mean plentiful in these FX options. So you can get implied volatilities for x1, x2, and y. You've got implied volatilities for all three, right? Which means that you've got everything in here except rho. Okay, and this allows you to extract a market implied correlation from market implied options. Okay? And this is useful. It allows you to sanity check correlation. If the markets, you've got to extract something sensible. Okay? If you expect two FX pairs to have positive correlation, but you do this exercise and it comes out to be negative, you know something's not quite right. Right? Either in the market option prices or in your understanding of how the two assets truly are correlated. You can use this to extract correlations which you can then use to price basket options. So remember a few weeks ago, we talked about the dangers of correlation. We talked about where do you get correlation from. We talked about people constantly over time misjudging correlation. This is kind of a red alert system. If you run this every day and you see correlations are starting to do something funny, you know something's going on in the market. Okay? And maybe these are better correlations to use in your basket option than some other correlation that you came up with using historical data. Historical data looks at the past. Implied volatilities are now. Okay? They're forward-looking. So this correlation is a forward market-implied correlation. So there's this correlation triangle, right? If you have two FX pairs, you can construct the third by taking the ratio. And if you've got the volatilities of each of those components, you can extract out the correlation. Any questions on that? How do we extract the volatility for Y? How did we extract the volatility for X1? Perfect. It's the foreign exchange option on buying pounds for dollars, right? You extracted it from the implied volatility. Perfect. Exactly. Yeah. Exactly. Correct. No. The foreign exchange rate cannot be negative. What does it mean for a foreign exchange rate to be negative? The interest rate can be negative. Right, interest rate can be negative. But here we're talking about foreign exchange rates. X1, X2, and Y are all foreign exchange rates. So the foreign exchange rate has to be governed by a log normal distribution. Right? Normal doesn't make sense. But yeah, good questions. Go. Yes, correct. Correct. Because remember, those are two assets that are measured in dollars for some other currencies. Well, it depends which way you want to go. But yes, the correlation, knowing correlation, if you know correlation, well, these two you know, you extract from the markets, eh? Now the question is, where does this come from? If it comes from the market, then this is implied out. If instead you don't have this, it's a good question. Maybe we're talking about pairs that are not liquid. Correct. In that case, if you're talking about pairs that are not liquid, you don't have this in the market. You can build it out. Yeah. Correct. Okay, next topic, final topic for today, which is it's a big topic. It's a complicated topic, but it's part of FX, is the idea of quanto derivatives. And quanto means currency protected. That's what quanto means. So here's the case. You're an investor and you're constantly looking for good opportunities in the market. Okay? You're looking for investments that are going to make a lot of money. And you've got your research guys all over the place researching different countries, different economies, different assets. And you figure out that there's this startup in Turkey, right? You think Turkey's up and coming as a country. This startup has a good idea. They might even, based on your research, win the mandate to provide some service nationally over all of Turkey. But at the moment, they're a startup. They're a small company. And you think there's a good opportunity here. You want to invest in this company. And you go ahead, you invest, however, $100. And it takes time. You wait 5 years, and sure enough, this company's done very well. Okay? Everything they invested in, their ideas worked out. The company's stock price went up in Turkish lira, right? Because they're based in Turkey. It's gone up, everything's good. Your investment was sound, your research was sound, everything went well. And just say you're a dollar investor. Okay. 5 years down the line, you're looking at the Turkish FX rate. Maybe you went in here, $1.15 Turkish lira. Your company did well, but look at what's happened to the FX. Okay? $1 is now worth 40 plus Turkish lira. In other words, you made the right call, right? You found the right company, you made the right investment. The foreign exchange rate worked against you. Okay? What you would really like is to have been able to invest in this company, right, somehow, in the stock of this company, but without the risk of the FX. Okay? You wanted the currency protection. So quanto options are exactly the type of derivatives which allow you to invest in a foreign asset, but not take on any foreign exchange risk. Okay? That's what currency protection means. And this is the use case, right? Now, this is not realistic. Chances are you've not just been blind and not following the FX rate of Turkey. You probably saw this coming and you did something about it. But I'm trying to demonstrate the idea. Okay? Even over a short term, you don't want to take any foreign exchange risk. You buy an option over 1 month, you don't want any foreign exchange risk. You just want the gains or the losses of the underlying stock. And you want them to be kind of converted back into your local currency at today's rate. Okay? So whatever today's foreign exchange rate is, you want to say, let me freeze this forever. I want to freeze at this level. Okay, so you're not taking on any foreign exchange risk. That's exactly what I've described there is exactly what a quanto derivative is. Okay, so it offers you currency protection. And I've given you, I've made the case for why you'd want it. Now, it's not FX, right? The whole point of doing this is that you want to extract yourself from the risk of FX. Okay, so the derivative is not an FX derivative, but it's not quite single currency either, right? Because you've got a foreign asset. So you're a dollar investor, but you're talking about a foreign asset. So this is kind of, feels like it's sitting somewhere in the middle, right? It's not a full-fledged FX thing, but at the same time, the whole point of it is you don't want to take on the FX risk. We'll see in a few slides that actually, from the perspective of the investor who bought the option or bought the derivative, they're completely kind of one currency mode. Right? That's why they did the trade. They wanted to buy an option on a stock but not worry about the FX. From the perspective of the bank who sold this option, the problem is a lot more complicated. They do have foreign exchange exposure. Okay? They're synthesizing this derivative. That's their business model. They're selling these derivatives. They need to sell it at a price that reflects their hedging costs, their replication costs. So FX does come in. So we'll look at a quanto call in detail, right? So let's say it's a foreign asset. Okay? F means foreign asset. Think in Turkish lira. Okay, it's an equity. And you want a call option on this foreign asset, but you want it paid in dollars. Okay, that's the difference. You want it paid in dollars. Even though this thing on the right, truth be told, it's a Turkish lira number, but you want it paid in dollars. Now maybe you have a fixed exchange rate here. I don't know, let's call it F. Fixed number, today's exchange rate. Okay, that's what converts it to dollars. It doesn't matter, it's a constant, right? We can always add it in as a multiplier later on. So the point is that V, a dollar-denominated derivative, depends on time, as always, but it depends on some foreign stock. Okay? It depends on the price of some foreign stock. That does not make V in the foreign currency. V is still in the domestic dollar currency. So how do we do this? Our pricing framework is always the same. Replication, self-financing. What are the assets we have? Well, we have the foreign stock, SF, and we have cash. We have domestic cash and we have foreign cash. Domestic cash we've always had. It's the money market account. But we also have the money market account in the foreign currency. And you have to wait a couple of minutes, a couple of slides to see why that comes in. Okay, so what are our hedging instruments? And here now we really have to pay attention to the difference between a price process and a wealth process. Okay? Because if you buy 1 unit of foreign stock, what you really care about as an investor in that stock is the wealth process. Okay? In this case, the wealth process isn't just a function of whether the stock price goes up or down, it's also a function of what the FX rate is doing. Okay? So let's start off with the easy one. Domestic money market account doesn't change. That's what we've always had. By the way, in all of this, I'm going to assume constant interest rates. Right? We're only dealing with the quanto feature here. We're not dealing with stochastic interest rates. I mean, that's another layer we can add on, but let's leave that to one side. We're only dealing with one thing at a time. We're dealing with the quanto feature. Money market account, same as always, nothing new. Foreign asset, in foreign currency, same as before, nothing new. Okay? It's the log normal model. We have a foreign exchange rate. Okay? Number of domestic units per 1 unit of foreign currency. This is the part where we talk about the wealth process of the asset. Okay? It's not enough to talk about S of F anymore. You have to talk about this product. This being the exchange rate that converts this into a domestic currency. That's what you care about. Right? And I'll let you go through the maths in your own time, but basically it's a product. If we call S bar this product, we can easily figure out the stochastic differential equation for it. Again, these are the kind of questions you could be asked on an exam. Okay? You could be asked to compute the stochastic differential equation for some product, if you're given the stochastic differential equations for each term. It's just chain rule, but you have to remember about the Ito term. Okay? The Ito term is what gives rise to this correlation term. Okay? The Ito term, remember, S bar is linear first order in S and F. So there's no d squared by ds squared. There's no d squared by dx squared. But there is the cross term. So, okay, so this you can figure out. Okay? It's the wealth process of the foreign asset. What about cash, holding foreign cash? We can make same argument. If you hold a foreign bank account, what you really care about is how much does that foreign cash translate into dollars, into my domestic currency. So once again, the foreign bank account gets converted by X, spot FX, into the wealth process of the foreign bank account. Here it's simpler because B is deterministic. Okay, so you only have, there's no Ito correction, there's only dx. You write that down. This is the wealth process of the foreign bank account. Okay? That was all really just set up. We're going to do the same thing, right? We're going to set up a hedge portfolio, pi, which is our derivative plus some units of foreign cash, some units of foreign asset, plus the domestic money market account, that's what we've always had, plus some units of foreign cash. Okay? Maybe it's not obvious why we're doing this just yet, but you'll see very soon why we need to include this term. Right? So this is something we've already seen. We're now concerned with the wealth process. Wealth process, this is just the same. It's already in dollars. Okay? And our goal is always the same. We want pi 0 to be 0. We want d pi to remain 0. Okay? That's what it means to replicate the derivative. That's an identity which we might use later on. Self-financing strategy, same as before. Not quite the same, there's an additional term. We're now saying that if you need to change your holding in the stock or any holding in foreign cash, you can finance it all with your local bank account. Okay, so it's a closed system under local currency. That's the self-financing strategy. And that's the economics part. Okay, really the economics part is, if I have a foreign asset, I need to think of it in my local currency terms, right? And I need to do the maths to translate it. So remember, I've got pi is equal to v plus delta s bar. And now I'm trying to work out d pi, so I need dv. That's that term. Same as always, right? Hasn't changed. V is a function of TSF, not of S bar. Okay, same as when we saw with FX. It's a function of the price of the foreign asset. And I'm going to put everything together. These three terms at the end go to zero. That's the self-financing strategy. This term is just from up there. And, well, each of these terms come from the slide above, which I had in green. Okay? So these terms all come from here, here, and here. Now the rest is just messy algebra. You've got to plug it all in. You've got to put it all together. There's no other way. You put it all together. This whole thing is d pi. This whole thing is what we want to be zero. Okay? So this whole thing is d pi. And we want this to be zero. And you've heard me say it so many times now, how do we make it zero? Well, we have to eliminate randomness. We have to perform delta hedging. And what do we have? We have dw1, but we also have dw2. Okay? We have dw1, which we can hedge out with delta S, and we've got dw2, which we can hedge out with delta X. So we're doing two-dimensional delta hedging now. Okay? We have two sources of randomness. We couldn't avoid this one, because after all, we're writing a derivative on S. We couldn't avoid this one. This came in from S. But we were forced to take on this one because we care about the wealth process of S. And the wealth process of S introduces Fx. And Fx introduces the second term. Okay? So we can't avoid that one either. That's why we needed the cash. Right? That's why we needed that second term, which I said, wait a few slides to understand where it comes from. You needed it precisely because you need something to remove that randomness. Okay, so that's big picture, right? Please go through it in more detail. I'm sure you're all tired. Maybe some of it is making sense, some of it is not. But basically, economically, we're doing two-dimensional delta hedging. And I'll show you the result. Again, the details are quite a lot of details are in the notes. Quanto derivatives. Okay, so it's all here. Okay, that's the PD we're aiming for. The details are all in the notes. Again, it fits on a little over 1A4. Essentially, you figure out that you're doing two-dimensional delta hedging. You need to use that delta S, that delta X. And if you do it, this is just a repetition of the previous slide, but all these terms in light gray just disappear as a result of delta hedging. Okay? So you see, most of them have gone. And what you're left with actually doesn't look all that bad. That's a familiar looking derivative. That's familiar. These deltas are just derivatives with respect to S, so they're familiar. So it's already beginning to look a lot like what we'd normally see with the Black-Scholes partial differential equation. We do a little bit more maths, you end up with this. You can use this condition which came from up here. Okay? This condition because pi is 0. So if pi is 0, you just rearrange. Right? That's all we've done. Okay? But essentially that comes in. You can use that relationship as well. And you end up with that PD. Okay? Put this in. Looks even more familiar. Okay? First order derivative with respect to t, second order with respect to s, first order with respect to s, RV. I mean, that looks very similar to the Black-Scholes PD. Right? And you can do the same exercise again with Feynman-Catch, and you figure out that actually you can price V either by solving the PD or by solving this expectation, okay, which miraculously looks exactly the same as the risk-neutral valuation in single currency. Okay? RD is the domestic interest rate. That's what we've always had. V is the payoff. The only difference is here. The risk-neutral dynamics now look a little bit more complicated. Okay? We've always... Well, we can do better. Let's rewrite it, actually. We can rewrite this by introducing Q. Okay, I'm just going to introduce Q. And then write this as the risk-neutral dynamics for S. Okay? And what does it remind you of? Well, it's just like a dividend-paying stock. Okay? In other words, pricing-wise, this is very similar. In fact, identical. It's identical to pricing an option mechanically, right? I'm talking about the mechanics, the mathematical mechanics. Identical to pricing a derivative on a very similar, not identical, very similar to pricing a derivative on a dividend-paying stock. All right? We've just got some more terms in, but that's okay, they're constants. Okay, all these terms here, they're all constant. R is constant, RF is constant, correlation and volatilities are all constant. So mechanically, to price the derivative, it looks like it's pretty straightforward. But we know underneath, okay, remember the simulation I did for you, the delta hedging simulation. You know there's a lot more going on, right? You've now got two-dimensional delta hedging. You've got to maintain a position in delta S, position in delta X. So don't let the pricing fool you. It looks very simple. And to come up with a price, no problem. If you can price an option on a dividend-paying stock, you can price an option on a quanto option. But under the hood, the real work, the real science, if you're a trader who's just sold this option, you've got a lot more work to do. Okay? You're hedging in two dimensions. But it's invisible here. You don't see any of it. Okay? X doesn't even come up here. Have you noticed? X doesn't even come up anywhere. We've got sigma x, we've got correlation between x and s, but x itself doesn't come up. For all intents and purposes, this looks like a one-factor problem. Right? It looks like a one-factor problem. But it's not really. Okay? Economics, in terms of what you're buying and selling as a trader, it's definitely two-factor. It's definitely two things going on. Okay, so this thing here is called the Quanto adjustment. Right? Maybe it's their way of saying that this, from a pricing perspective, looks very similar to what we've already done before, but you need to make this special adjustment for the case of Quanto. So go through that in a bit more detail. Because really all of the effects of Quanto are wrapped up into this Q. Right? Correlation, sigma x, they're all wrapped up into Q. Right? If the Q didn't exist, this is kind of a non-FX, non-Quanto problem. Right? So that's something you have to be very, very conscious of. The FX rate does not come into pricing, but it definitely comes into the hedging. Okay? And you can study at how the value of the call option changes with correlation. Okay? Because it's going to change with correlation. And I'll leave you to think about what that means. Why can you rationalize how the correlation affects the price? Just go through the maths. But the maths will tell you, right? You increase correlation, it increases Q. If you increase Q, it does something. So mathematically, you can easily work out what's going on. A little bit more complicated is to understand what's going on with the hedging strategy. Okay? All right, are there any questions? I'm going to leave it there. It's almost 10 p.m. You guys have had a long evening. Any questions? There is a problem set for this week. It's already been published, so take your time, look over it. I will publish the solutions probably in a week. Next time, which is Saturday, we will start on interest rate derivatives. So Saturday's session is in LT34, 2 p.m., 2 to 5. There are no more problem sets for the course. FX is the last one. Sessions 12 and 13 are kind of quite closely related, but they are more advanced topics. Okay, any questions? Last chance? If no, then I'll see you on Saturday.